Hi, I'm Michael Thornycroft, Corporate Communications Manager at Vanguard Australia. Today I'm joined by Jeff Johnson, Head of Fixed Income, and Scott Cornfoot, Senior Investment Specialist, to discuss the asset class of fixed income in its current market climate and what investors should consider. We often talk about the benefit of diversification both across and within asset classes, but there's also diversification between index and active options within your portfolio. For active fixed income investments, are there different considerations investors should be aware of?
I think, Michael, it's important initially to define what we at Vanguard mean by active versus passive, because it's a very strong ongoing industry debate. Basically, we consider anything that steps away from large market capitalisation strategies to be a active tilt. So those tilts can come in many different forms. So when we consider active, we do believe that it can be an important part of a portfolio and can add an additional return stream. It is very important though that investors understand what the active strategy is, how it works, how it behaves in different market cycles, and the risk that the manager is taking within that active strategy.
Just a couple points on this. We've talked a little bit about how we're in a low interest rate environment and rates have crept up. Globally, they've crept up a little bit here in Australia, but we still remain in a relatively low interest rate environment. So what that means is that the expected return on bonds as an asset class is still constrained. We're probably talking about 2.5%, maybe 3% over the course of the next 5 to 10 years. In that kind of environment, if we're reducing the amount that we earn on those fixed income assets by management fees, it makes a relatively low expected return outlook even lower. So it becomes really, really important that if investors are going to move into a more actively managed approach, that they get the manager selection part of that equation right. I think the other point that I would just make on this topic is that many investors, many advisors have to make a lot of active decisions when it comes to formulating an asset allocation or formulating a policy portfolio. They need to think about how much credit do they want in the portfolio relative to government bonds? What's the right duration that matches their time horizon? How much domestic and how much international exposure should they have in their portfolio? These are all active decisions that an investor needs to make with their advisor. The good news today is that advisors and investors have many index-oriented solutions that they can choose from once they make all of those active decisions. They can gain exposure to domestic bonds passively. They can gain exposure to international bonds through an index vehicle. So they still have a lot of control and they can still make a lot of those active decisions to formulate the approach and the plan, but they can implement it in a low-cost, broadly diversified and indexed way.
And probably a final point on that is to be very aware that when you're purchasing an active strategy, that it truly is active management by that manager and not an overweight or a systematic exposure to a factor that just gives you higher returns. And an area where this can be prevalent is within credit, where we're taking lower quality credit investment to generate higher returns.
Given these expectations that interest rates may rise, should investors be doing something differently at this time with regard to their fixed income exposure?
In a word, no. This is an asset class that we believe has an enduring role in all investors' portfolios, and we believe that way because of the diversification benefits of bonds relative to other riskier asset classes. In risk-off environments, bonds tend to provide significant downside protection relative to risky portions of the portfolio. They generate income that tends to outpace inflation over time, so that is a key characteristic of the asset class that benefits investors. So again, put simply, Michael, no, we wouldn't advise investors treat this asset class now any different than they normally would, despite the fact that we're in a rising rate environment. And I would just remind investors that being in a rising interest rate environment is a good thing. It reflects generally strong economic fundamentals, and it means that they can probably expect to be earning higher levels of income on that portion of their portfolio going forward. A final point that I would make is we do just get concerned about investors moving away from an asset class like this in the face of rising interest rates, because we have to ask the question, where is that money going to be redirected in the portfolio? Equity market returns have remained strong, but equity market valuations also remain somewhat high, maybe even stretched in some markets. So we wouldn't want investors to abandon an asset class that has provided that defense and go into riskier areas when we've already seen some increases in volatility so far present themselves in markets.
And we have seen many investors be tempted by term deposits or shorter duration portfolios. And that's okay if you're only interested in low levels of income, but if you're seeking diversification benefits within your portfolio, bonds remain the best source of diversification.
So are we seeing investors look for alternatives to a traditional fixed income investment given the different conditions we're facing?
In some areas we are, Michael. It's tempting with bond yields being low to seek alternative sources of higher return. Another area that people are looking at is into hybrids. So hybrid securities are typically issued by banks and they do exhibit equity characteristics. When everything is smooth sailing and going well, that's fine. Hybrids tend to perform well, produce strong income. The challenge is that when risk assets suffer, hybrids also tend to perform very poorly. During the GFC, the hybrid market performed very badly. Government bonds performed very well. Bonds provided great diversification against a poorly performing equity market. Hybrids behaved like equities. So we would advise, for diversification purposes in your overall portfolio construction, to take a serious look at bonds and be wary of hybrid investments.
Jeff, Scott, thank you so much for your time today. If you'd like further research and commentary from Vanguard Australia, you'll find it on our website. You can also follow us on LinkedIn, Twitter or YouTube. Thanks for your time.